All right, guys, big week last week. A lot of things were announced. The markets are up a ton. First off, inflation was 7.7%, which made everybody go nuts because it was lower than I think it was 8.2 or 7.9, whatever it was that everybody was expecting. 7.9, I think. So everybody said, oh my God, this is over. Inflation's done. Okay. Consumer sentiment came in and it dropped big time. Now, this is consumer sentiment. It doesn't include the last reading, but look at where we're at relative to history. Guys, go do your research on how bad the early 80s was. This was literally 11% unemployment, 15% of interest rates. I mean, it was crazy. And consumer sentiment is lower. Consumer sentiment is what the consumer believes about the future, the near-term future on their jobs, their money, etc. And I believe it came in, well, we can look at it right here. It came in at 54.7. So let's go back here and look at this graph. 54.7. 54.7 is like right here. How many times in history has it been lower than that? Oh, guys, the financial crisis, it was higher. During the financial crisis, it was higher. During COVID, it was higher. It was higher during COVID. Come on. Like, give me so to me, consumer sentiment, it might be what leads us down the road of pushing us a little bit over. I see companies announcing tons of layoffs. Is it a lot of, yeah, it's Meta here at 11,000. But the point is, yes.
Those companies were just growing and growing. I think one of those companies doubled their labor force over COVID.
Yeah.
I think it was Facebook. I think it was Meta, Facebook at the time. They doubled their labor force.
But the point is about this is that you go from seeing companies never talking about layoffs to all of a sudden every company is saying, well, we're going to stop our hiring. Even Apple. Apple literally, in the time that this video is going to take to be made, they're going to make like $100 million. And I'm not exaggerating about that. Yeah. Like, that's probably true. And they're talking about layoffs.
I thought Google was an interesting one because they were talking about just slowing hiring and everything. And
sorry, that's what Apple said too. They just talk about slowing hiring.
Now I think they're starting to do that reversion to, okay, maybe we're going to be layoffs.
But why is that? In my opinion, once somebody starts and it becomes a trend, they can start sitting there going, yep, we're going to lay off, we're going to lay off, we're going to lay off.
They're not the first person.
Amazon's going to do $150 billion in revenue in the fourth quarter. And they said we're going to immediately lay off 10,000 people as well.
Yeah.
So what's going on with the holidays here, Mo?
So holidays, sentiment as far as the stores are saying and retail, it's not good. You see Amazon coming out and saying, hey, we're going to break even this holiday season. And that's Amazon. Then you have all of these inventory issues. Target was talking about how they had way too much inventory. Walmart, way too much inventory. And now they've all cut their guidance going forward. And they're going to say it's going to be a pretty bleak holiday season. What they're trying to do is get rid of excess inventory that they didn't have inventory during COVID. They went crazy and bought it all, and now they're just stuck with it.
Yeah, and it's at some point,
it has to go boom in a bad way.
Well, listen, I'm not trying to.
And another thing about retail,
yeah,
people are not going out there buying your discretionary items. They're not going and buying TVs and coffee makers they don't need and this and that. They're buying essentials now.
Yeah.
So this is another big problem that you're seeing in retail.
So think about it that way. You've had a few years of buying a ton of stuff that's awesome. If you want that new TV, you might be like, you know what? My TV's okay.
Yeah. Maybe I'll wait till next year or 2 years from now.
So another avenue of the market that I really want people to look at is home prices. Yeah. Home sales have plummeted. I know some people thought it was an inventory. It was not. It was just when interest rates go from 2.6% low to 7.5%. I think it's now below 7% again.
It's 6.62%. You'll love the story that I'm going to pull up, but go ahead.
So, anecdotal story. I was at lunch just now with a good friend of mine. And he said to me, in his area, it's kind of a remote area of Cleveland. Like, he doesn't even consider Cleveland. There were 3 Ryan home developments. The first 2, he's like, Paul, literally every time I rode down there with my bikes to my kids, 15 more houses sold. The third one went in, and it's still only the model home.
Wow.
He's just like, I just look at it going, oh my God. Well, yeah, of course. Because guess what? Before, when interest rates were 3.5%, every $100,000 you borrowed was $300 a month, essentially, of interest only, if you did interest only. Now it's $6,600 every year, or $550 a month. That's a big increase, especially if you're making $100,000 a year.
So this person that wrote this article in MarketWatch said that millennials should jump at 6% mortgages like banks, like bears grabbing honey.
So I don't necessarily disagree with that.
Really?
Why do you? Yeah, and here's why. A 6% mortgage is still pretty reasonable.
It's actually 6.62%.
We've been spoiled.
We have been spoiled. It looks really bad.
It looks really bad because we've seen 2.6% interest. Yeah. To me, guys,
I'm surprised you said that though.
Well, because I do think 6% are reasonable. And by the way, at that point, my comments will change. If you watch our past videos, I've sat there and said, if you're borrowing at 3%, you're crazy to pay off your mortgage. I do believe that. If you're borrowing at 7%, you're going to get guaranteed 7% more return when you write that extra check every month. That to me is pretty good Because right now, what's your guaranteed rate of return? Basically 3.9%, 4% on a 90-day treasury. But now you can go pay off your mortgage at 7%, give yourself a guaranteed 7% return. Not bad. 3% though? Man, you can crush 3% in the market. Can you crush 7% in the market? Yeah, maybe over long periods of time and with much more fluctuation. But with mortgage rates at 7%. So one of our good friends, Hesh, he told me the other day, he goes, hey, he's like, we still do 160, 200 mortgages a month.
Wow.
And we just got a new first-time home buyer. They don't know what 3% is.
Oh, yeah.
7.5%, 250 mortgage, putting 20% down. Okay.
Good point.
They didn't understand. I mean, now granted, if they'd been in the market a year ago, they might have been buying a $400,000 house instead of a $250,000 house.
Right.
Now, is there a plus side to it? Well, yeah, inflation. Inflation can drive up all these prices still. I saw a report from, I think it was NVR Homes, where they had a 15% drop in sales, but their median home price sale was still 3% higher. Why? Inflation.
Yeah.
Inflation can cure a lot of ills in terms of seeing that top line number not change much or actually go up. I've said it before. Back in 1975, the average rate was 9% and the average home was $32,000 a year. In 1985, the average rate was 13.5%, but the average home price was $81,600. So 50% more mortgage, almost triple, 2.5 times more home price. Why? Inflation. Go look at inflation between 75 and 85. It was like 10% a year. Maybe not that high, but the point is inflation can save home prices. So if you already own a home, congratulations, you're probably going to benefit a lot. If you don't own a home yet, I still caution you to only buy when you know you're going to be there for a long period of time and realize that your rate is not going to be 3%. Now, could it fall if we have a recession and the Fed wants to? Yeah, sure. I don't know where rates are going to go. But the good news is if you lock in a 7% mortgage and rates do plummet, guess what you get to do? Refinance. If rates go back to 5%, you better believe you have a $250,000 mortgage. It'd be very beneficial to refinance at 5% versus 7%. You'll save yourself $400 a month. So the economy in general, stock market is up last week, still down for the year. Stock market, surged last week. I don't think we're anywhere close to done.
So what do you think is going to happen going forward? Everyone is talking about this Powell pivot where they loosen up on interest rates.
When you say loosen up, tell me what you mean by that, because this is the big thing people are missing.
Yeah, so a lot of people are, we've seen, 4 consecutive meetings of 75 basis point hikes? So now a lot of people are saying, hey, we're going to see 50 basis point.
See, that's not a pivot to me. A pivot to me is I'm raising 75 basis points and I'm decreasing now. No, it's just
their pivot is they're slowing the pace of
They're slowing.
Yeah.
I do think that's going to happen. Now, they've already indicated it's probably going to happen. If inflation comes in lower again, they might sit there and say, listen, this is good. But Powell has said, I think it's a bigger mistake to under increase in rates than to over increase rates. He's worried about keeping it too low because he's worried about inflation skyrocketing out of control.
I think that's a much better side to err on.
That's what he thinks. I don't really have an opinion either way. I've always been in favor of higher rates. The reason being is the lower rates are, the easier money is, and the less hacks are out there competing with me on deals that they'd have no idea about. And then later on, when they F up, they blame guys like me saying, oh, you guys, no, I'm just a lot smarter and more patient than you. I'm sorry. And it's okay to have higher interest rates. It is okay. It'll bring prices down for everyone, including you. And if you're young, and you should want stock prices to be really, really, really low. If you're under the age of 50 and have 15 or 20 years to retirement, you should be begging for interest rates to be high and stock prices to fall in half. Yeah, you have a temporary loss of net worth. Who cares? Put more money in the future towards higher rate of returns. That's what you should want. And the economy, guys, I'm going to tell you something. Here's a little news flash about the economy. The U.S. economy is going to continue growing, and it's going to do well. And we're not going to become this third world country suddenly just because China is growing. Look at Great Britain. Great Britain in the last 200 years has still been a powerhouse economy, even with us overtaking them. It's going to be okay. If you believe in the U.S., you should believe in the fact that, yes, we are a wealthy country, and it's not possible for this per capita income to grow the way China is. Why? Because China is such a poor country per person. They have a lot more growth potential. I have homes in Mexico. We have homes in Mexico. They're a lot poorer country. They're going to grow at a faster rate than us in all likelihood. And that's a good thing for everyone. So stop worrying about the day-to-day stuff. We do these stock market and economy updates just to give you a feel of what's going on out there. But at the end of the day, I care about one thing and one thing only. Has anything changed for me fundamentally for the next 20 or 30 years? And for me, the only thing I worry about is this debt level that we have as a country. Mo, what'd you see on the billboard?
It was over $31 trillion.
So there's a billboard.
Debt, and then $95 trillion about per person.
95,000.
My 95,000 per
whatever
person.
The number is. Yeah. Guys, there's a billboard going to downtown Cleveland where it talks about the national debt. Guys, the national debt really is an issue for me. But I know that inflation is going to help that national debt number. Because look at our GDP number over the last few years. Guys, this is our GDP, 25.663 trillion. Just 4 years ago, let's go back to the end of 2019. It's grown $4 trillion. Well, so that was 2019. The last time it grew $4 trillion, it took 8 years to grow $4 trillion, and we grew it here in a matter of 3 years. 3 years. It's because of inflation. Look at this jump. Look at these jumps in GDP, all because of inflation. So inflation will drive this fair value higher and higher and higher. Remember, not everything's a good thing. Not everything's a bad thing. So if you like this video, guys, subscribe to the channel. We do so many videos. It'll definitely be worth it, and you'll have a better understanding of investing in money if you do so. Make the good decision.